Question 11 says that a firm is evaluating a project that has a net present value of $0 when a discount rate of 8% is used. A discount rate of 6% will result in, basically what it's telling you, when you have a net present value of 0, that means that the actual return is 8%. Okay, so if what you want the return to be is 8 and the net present value is 0, that means what you're actually earning is 8%. So if you lower the discount rate to 6 and you're actually still getting 8%, that means that you're going to have a positive net present value. That means that the present value of the future cash is going to exceed that initial investment. Next question says that we invested in a project that required an initial amount of $52,160, return cash inflows of $10,000 per year for 10 years. What is the internal rate of return? Now, remember, for the internal rate of return, what you're looking for is the factor. So you know that to find the present value of the future cash, you take the factor times the cash flow. So you know the present value of the future cash because it sets equal to the initial investment. That's what it means for internal rate of return. Payment's 10. So basically you're looking for the factor. Your formula, if you want to write this down for internal rate of return, you just want to take the initial investment and divide it by the payment amount. Basically, it's your payback period formula. That gives you the factor. Once you know the factor is 5.216, you have to go find it on the table. It's every year for 10 years, so you know to look at the annuity, and you know to look across timeline 10. You find the factor, you look up, and it's 14%, so that is your internal rate of return. 13, the company is considering a project with initial investment of $2,226,000 that's going to yield net cash flow of $40,000 a year and will be depreciated at $22,006 over the next 10 years. What's the internal rate of return? We're worried about cash. We don't care about income. So depreciation is non-cash, so we want to ignore it. You work the exact same way as before. You take the initial investment divided by the annual cash flow. It's payback period formula. It gives you the factor. Again, it's every year for 10 years, so you use the annuity table, look across timeline 10 until you find the factor of 5.65 or closer to it. You find the closest thing you can, look up, and it puts you in 12% column, so that is your internal rate of return. Your formula used to calculate inventory to be produced. Remember, for inventory, just overall, you have beginning units. You're going to make some units, you're going to sell some units, and you're going to have some ending units. So you can write it in a T account such as this, or if you prefer just an equation, beginning inventory plus the amount made minus the amount sold gives you ending inventory. So if you're trying to figure out how many to produce, basically just flipping the formula around, the amount sold minus beginning plus ending is going to give you the amount of units produced. Next question, how many boxes should be produced in February? To figure out how many you should produce, remember your formula is to take the amount of the sales for the current month plus how many units you would like to have in ending inventory, then subtract out your beginning inventory. Okay, so again, the formula for production is to take the number of units you're going to sell during that period plus how many units you want to have in ending inventory, then subtract out the beginning inventory. This has been set up as T accounts. You can work it this way also. Beginning plus production minus sold gives you ending. We're worried about February. It tells you that we expect to sell 4,200. In February, so we got to figure out how many we need to make. So we're going to sell 4,200. We would have 780 left. We know that to come up with ending, it tells you that it's 20% of the next month's sales. So the sale that follows February is March. So 20% of 3,900 gives you your ending inventory of 780. So 4,200 plus 780 minus the beginning inventory. The beginning inventory is the most difficult to find. Remember, for beginning inventory, you need to think back to the prior period's ending. So basically, how many units were we going to have in ending inventory in January? In January, ending inventory is equal to 20% of the next month's sales. So it's 20% of February sales, which is 8 840. So subtract out the 840, and that leaves you with 4,140 units. That's how many you need to produce. Next question. Production is going to come 3 months as budgeted. What's the direct labor cost budgeted? So basically, we need to figure out how many hours it's going to take to meet the production needs and turn that into a cost. So this tells you how many units we've already figured out we need to make. Tells you that each hubcap takes an hour and a half, and it tells you the cost is $13 an hour. So the question says, what's the direct labor cost budgeted for September? So in September, we're going to produce 48,000 hubcaps. It takes us an hour and a half to make each one. So that means we're going to spend 72,000 hours producing hubcaps. If we have to pay the workers $13 an hour, that means our cost will end up being $936,000. Next questions have to do with production budget. This has to do with direct material purchases. So basically, for purchases and production, the formula you want to use is the current month's production needs to meet sales plus ending inventory minus beginning inventory. So we've got to figure out how many pounds of berries we want to purchase during the month of November. Now this talks about producing jars of jam. So this is the number of jars of jam. It says that each jar requires a half a pound of berries. So at some point you have to convert number of units into the quantity of the material. Our material are pounds of berries. So off the bat, what we've done is we've taken the number of units, multiplied it out by half a pound of berries, and that tells you the pounds of berries that you're going to need for each month. It says that ending inventory is equal to 3% of the following month's production needs. So with that, we can now calculate how many pounds of berries we're going to purchase in November. So in November, we know that we are going to produce and need 48,000 pounds of berries so that we can meet that month's sales quota. Okay, so current production is 48,000. We want to add to it ending inventory. Ending inventory is equal to 3% of the following month's production needs. So 3% times 31,500 means at the end of the month, at the end of November, we want to have 945 pounds of berries. Then we want to subtract how many berries we already had from beginning inventory. Beginning inventory is equal to prior period's ending. So in October, we want to have 3% of 49,000 or 1,470 pounds. So 49,000 plus 945 minus 1470 gives you the pounds of berries of 48,475 pounds. That's how much we need to purchase. 18 says, what is the dollar cost of purchases for October? So you need to do the same thing we did for November. You've got to calculate purchases. So you've got to take production needs plus ending inventory minus beginning inventory, which is easy this time because they give it to you. Figure out we need to purchase 37,845 pounds of berries. The cost per pound is 60 cents per berry, so that gives you the cost of $22,707. The next question says that we make all our sales on account, so that means all the sales are credit sales. So we're worried about when we're going to collect all these sales. So everything goes to AR, and this is when we collect the AR. We get 25% in the same month. We get 64% in the month after the sale, and then we get the last 5% in the second month following sale. It tells you the sale information per month, and it says how much of June credit sales are expected to be collected in the month of July. So we're just focused on 1 month. So in June, we had $115,000 of credit sales. We know that we're going to collect 25% of that in June. We're going to collect the other 64% in July. And that's all the question is asking you for, is how much of those credit sales are collected in July. So 64% times 115 gives you $73,600. The next question says, what is the budgeted cash to be collected in August? So now we're worried about, okay, in August, how much are we collecting in total? So you've got to think about the sales from that month plus the sales from the prior months. So if you think about August sales were 132,000. We know we're going to collect a quarter of that in the same month. So 25% of that is going to be collected in August. The rest of August sales aren't going to be collected until September and October. Now we want to think backwards and think back to July and say, okay, we had sales in July of $126,000. How much of that is collected in August? Well, 64% is collected in the month following sale. So you had $126,000 of sales in July, but you're going to collect 64% of that in August, which is $80,640. Then you think back even 1 month before that and think back to the June sales. Say, okay, in June I had sales of $115,000. I'm going to collect 25% of that in June, 64% of this in July, and then the last 5% I'm going to collect in August. So total that up, and your total sales for August is $119,390.